Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. We begin in China, where French President Emmanuel Macron met earlier with Chinese President Xi Jinping. Now, this meeting took place as Paris is trying to rebalance its economic ties with Beijing. Here is Bloomberg China correspondent Minmin.
Just judging from the tone coming out of these state media commentaries so far, it's been heavily covered in China. President Xi calling the meeting candid and constructive and fruitful. There has been a range of cooperative agreements signed covering areas like natural resources, like agriculture, food, education, investments. I think the key focus for Macron is really to deepen trade and investment ties, right? He called for more Chinese investments, saying that it needs to be a clearer framework to attract Chinese investments. He also warned against supply chain disruption, and that was likely a reference to China's disruption of the rare earths access for European countries, although some of those restrictions had been lifted. But it spooked many European partners about over-reliance on China. He also urged China to expand its domestic consumption, saying that one of the worst ways to deal with the trade imbalance is to start a trade war. And I think a key focus for him is to correct the trade imbalance, given that France still has about $50 billion in goods trade deficit in 2024.
That was Bloomberg China correspondent Minmin Lo. Now, today, across the Asia-Pacific, equity markets are somewhat mixed. A key question looming is on Fed policy, not just the high probability of a rate cut next week, but the Fed's outlook for next year. And that's where we begin our conversation with Charu Chanana, Chief Investment Strategist at Saxo. She spoke with Bloomberg TV host Avril Hong and Paul Allen.
Talk to us about why you think maybe next year will be even better for risk and Asia in particular.
Yeah, absolutely. Okay, so let's take the broader picture first. It does seem like we're getting that rate cut from the Fed, and then going into next year, if at all, the probability seems to be getting higher for an asset-led Fed, and that does mean that we could get some more rate cuts going into next year. I mean, of course, the market's already looking at 3 rate cuts for next year. I've seen predictions of about 100 basis points of rate cuts as well. So about 3 to 4 rate cuts next year looks very likely. And on top of that, of course, the tech volatility has gone up, but that has not really kind of questioned the kind of capex that has been going on in this AI theme, right? If that continues, especially from the big, hyperscalers that do have the ability to in some ways fund it as well, I do think, of course, the dispersion would continue and the broadening of the AI theme would continue in the US. But overall, both of these macro dynamics are extremely positive for Asia, because if we do get that continued AI capex, the hardware backbone of that AI cycle really rests in Asia. I mean, we've seen that theme play out in Taiwan and Korea. I think it could spread out to some of the other names as well, beyond the big names that have already rallied quite strongly this year. Japan has been a huge participation in Asia. And as I think with the volatility in tech, as investors look to kind of shift away from hype to the real fundamentals, I think the real fundamentals are in Asia. When the US hyperscalers continue to spend with really little insights into where they monetize it, I think that spending continues to benefit Asia, who do continue to get strong order books on the back of that spending. And then you club that with Fed rate cuts, a softer dollar potentially, all of those are very positive for Asia.
On the Fed rate cuts, you say 3 or 4 next year. How much does it matter whether we see this first half or second half? And to what extent is it realistic to expect a very dovish Fed under potentially a Fed chair Hassett?
Yes.
Given he's one man, there are other people on the board, right?
Exactly. And I think we will start to get a reflection of that within this month as well, as to how divided the Fed board is getting. We've already got some meetings where we've seen that division play out. But certainly, I think this December meeting is even more important because we still have a kind of a data blackout. Even though the government shutdown is over, we haven't had the most recent data for the Fed to really judge about, where things are going. We've had obviously some political influence playing a part as well. So the division is certainly, getting much more starker within the Fed, and that will be a theme going into next year as well. But I think within the first half of the year, even if we do not substantially get those rate cuts, certainly depending on where the labor market is going, I think there is a chance that we might get another one at the end of the first quarter if the trend in the labor market sustains to point towards more weakness. But I think the market obviously reacts a little bit, faster than the actual rate cut itself. So I think that potential expectations of rate cuts would also continue to support the markets.
Charu, do you see dollar weakness becoming a major theme in 2026 as we see divergence between major central banks, particularly the Fed, and how's that informing your investment strategy?
It certainly seems like, we've obviously seen a lot of the dollar weakness this year as well. But going into next year, I think it'll be a dual story of both, yes, the Fed rate cuts, but also with those Fed rate cuts, I think the fiscal situation in the U.S. will also continue to play a big part. I think we might see, this pivot towards much more fiscal spending, which could raise concerns for the long end in the U.S. And that obviously, again, points towards, the weaker dollar. We've seen global central banks trying to obviously diversify their reserves as well, move away from the US dollar. So it does not still spell the end of the US dollar to me, because we know that, 88% of FX transactions, one side is still the US dollar. Even within trade, of course, we've got a little bit more relevance for the Chinese renminbi in this region. But I think globally, again, US dollar continues to dominate in a very significant manner, which is very difficult to overtake by any other, single currency, or even by gold for that matter. So I think the dominance really stays, but at the margin, these fiscal concerns also continue to be a negative for the US dollar next year, in addition to, of course, the Fed rate cuts.
Well, I know you say that while we're waiting on these rate cuts, while we're potentially waiting out an AI pause as well, you like to look for assets that pay you well during times of waiting. So can you give us some ideas in that regard?
Absolutely. I think with the yields, going down as well, especially on the short end, I think it is really important for investors who have parked cash, I think, to understand that, one, your yields are going down, plus two, I think we're also still in an environment of sticky inflation. So that also continues to erode the purchasing power for cash. So I think obviously it is very important to understand where you can get some of those better yields if you are an income-seeking investor, particularly. And in that case, I think it is next year could be a story where we see a lot of these dividend plays, things like REITs, for example, and other income plays very much in focus, given, of course, because of the volatility in AI, you want a little bit of a defensive balance in your portfolios. Because of high concentration of tech names, even in indices, you want to balance your portfolios with something more defensive, but also because, there are income-seeking investors who want to continue to generate steady income also.
Charu, just quickly if you can, when it comes to currencies, what do you think China is thinking about guiding the renminbi? Because it seems to make sense that it would be stronger. And then how does that square with what India is thinking when it comes to the currency?
Yes, two very divergent parts there, Avril, certainly. I think, so when we talk about China all year, we've seen that intent from China that they do not mind a stronger Chinese yuan now, right? It is a signal for them of a stronger economy as well. And given that, they do want to kind of, be structurally stronger, strategically independent from the global, economy, I think it was very important for them to continue to show that strength. But of course, the pace of appreciation in the Chinese yuan has, I think, obviously given, we got that signal yesterday that that's not something they're comfortable with. So my sense is here that they might slow down the pace of appreciation, but they're not going to potentially reverse it at this point. Whereas when you talk about India, obviously it has been, the Indian rupee has been extremely weak, and that also comes from, I would say, a policy stance or an intent to kind of be a bigger player in the global export or the global trade arena. I think the weaker rupee could help them there, and that might be the intention behind it. But I would say that they might slow down the pace of the fall of the rupee, but I don't potentially see them reversing that trend.
Okay, talking about trend reversals, the yen obviously this year has been coming under a lot of pressure. What is 2026 going to look like? I think part of the outrageous predictions that Saxo has is, 100 to the dollar?
Yes, but just to put it right now, outrageous predictions are not our baseline predictions. It's just something fun we like to do to obviously, encourage some level of debate. But also, I think there is a clear intent to try to look at some of the blind spots in your portfolios. Certainly this is not our base case, and it's not like we are telling our clients that you should prepare for a dollar yen going to 100. But what we've come up with is a set of 10 predictions which talk about the risks that investors might have ignored. So we take the trends that are already in place and we take them one or two steps further to really spark that thinking, what if I am exposed to this kind of a risk in my portfolio, or what if I'm missing this kind of an opportunity in my portfolio. So talking particularly about dollar yen, that is not a trend reversal for sure. That has been a trend that's ongoing for some time, right? We're still very close to these record low levels, despite the fact that we are expecting now, the market is expecting now the BOJ to hike rates later this month. And that goes to say a lot of things. One, of course, that the interest rate differential for Japanese bonds, which are obviously the yields are rising, but still so low that the interest rate differentials to the rest of the world are quite high. And I think that continues to pressure the yen, but also the fiscal situation, again, very much what we talked about for the US as well. Now we do have an intent to be, fiscally more accommodative, even more accommodative, I should say, in Japan. And that kind of raises, some concerns when you have 230% of, GDP in debt. So I think that kind of does raise some concerns. Again, it's not something that will immediately come to them because a lot of debt is held by the BOJ itself in Japan. But I think it's something that continues to concern investors. And of course, the carry trade itself remains quite attractive still. But things really start to turn if we see Fed cutting aggressively next year. I don't think the BOJ's small steps of rate hikes could really reverse the situation rapidly. But if the Fed really triggers like those 100 basis points of rate cuts and a very dovish policy, we could see dollar yen moving lower in that.
That's Charu Chanana, Chief Investment Strategist at Saxo, speaking with Bloomberg TV host Avril Hong and Paul Allen here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. Today, a bipartisan group of U.S. senators introduced a bill to block NVIDIA from selling its H200 and Blackwell chips to China. Now, the bill intends to codify existing U.S. restrictions on exports of advanced semiconductors to the Chinese market. It will also halt export licenses for sales of chips to adversaries for at least 30 months. Here is Gene Munster. He is co-founder and managing partner of Deepwater Asset Management.
If we don't sell some form of chips to China, they'll just go and create their own, and we can benefit in the near term of having them dependent on our platform. If you think of like NVIDIA, for example, it's not just the chip. They have a CUDA development platform. And so getting their developers based on that does give the U.S. some form of leverage in terms of how the technology rolls out in the years to come.
Today, shares in NVIDIA were little changed in the U.S. session. Overall, the equity market stateside struggled to gain any traction in front of next week's Fed decision. Let's take a closer look with James Thorne. He is Chief Market Strategist at Wellington Altus Private Wealth. He joins us from Toronto. Jim, thanks for being here. I think it's fair to say that markets right now are largely betting on the Fed cutting interest rates next week by 25 basis points. But it's fair to point out that policymakers have rarely been so divided. If we focus on the weakness in the labor market, are you expecting a cut?
Yes, I am. I think the larger question is, what economists would say is what's the terminal rate, or where does the Fed stop cutting? Is it going to be at 275? Is it going to be at 325? But one thing we know as investors is that, in 2026, liquidity is coming into the market, which should be good for risk assets.
So as we know, some members of the Fed have highlighted the risk of sticky inflation. On Wednesday, just the other day, we learned from the ISM that prices of services and materials on an annual basis are holding in at around 3%. And some of the other inflation readings that we have seen recently show inflation still above the Fed's 2% target. I'm wondering if that's a concern for you.
No, because I look at first, I recognize that shelter is one of the driving components of CPI and PCE, and we know that's lagged. And if we put market-based indicators into both of those variables, there is no inflation problem. And then, service inflation has always been sticky since I've been in the business for 30 years. So, what the Fed can do in terms of its monetary policy is really affect the business, the interest rate sensitive sectors of the economy. And I agree with Secretary Bessent that the interest rate sensitive sector in the economy is in a recession, specifically housing, and so they need to cut.
There's also been some debate as to whether or not lower interest rates can have a meaningful impact on improving the labor market. Maybe we need to consider some of the other forces that have contributed to a restructuring, and I'm thinking of AI in particular. Perhaps the labor market is not as sensitive to changes in rate policy as it once was.
That's a fair point. And, in these recoveries where, technology driven recoveries, labor lags. And I think there is some conversations or some indication coming out of the Fed that they indicate that the real risk is in the labor market, and we need to give support to the interest rate sensitive sector and wait to see if President Trump's supply side policies kick in and all that investment that is supposedly coming in because of tariffs. And if that happens, the interesting thing about it is that we're not going to go back to, secular stagnation and deflation. And the Fed can be right in basically saying that the neutral rate is somewhere around 2.75 to 3%. But if they tighten too much, and they contracted the balance sheet too much, as happened after the Second World War, you could get a real growth scare and debt and deflation really come back. And once you get those expectations going the other way, it's really hard to put the genie back in the bottle.
So I'm speaking to you from Toronto. Maybe we can talk a little bit about the trade relationship between the U.S. and Canada. Today, President Trump signaled the U.S. could withdraw entirely from the USMCA and renegotiate large parts of that trade accord with both Canada and Mexico sometime next year. Jim, I'm wondering, from your point of view, does the USMCA need to be restructured?
Yeah, it has to be restructured, yes. And, let's be honest, and this is how I frame it, is that, irrespective of President Trump, because interest payments on debt in the United States are greater than military expenditures, we have to, or the Americans have to adjust. So let's realize that and figure out what we're going to do. And so when you think about it, what Canada has to do is they have to basically start exporting their one, competitive advantage, right, which is natural resources. And so those areas of the economy that were protected under the USMCA, for example, autos, it really, we have to be honest with ourselves and to say that Canada doesn't really have a competitive advantage there, right? I mean, in Ontario, where I live in Toronto, right, with Premier Doug Ford, I'm sorry, electricity prices in Ontario are too high. So, Canada needs to do the structural adjustment, just like the United States. So I think we have to be honest and say, how is Canada and the United States going to create a relationship where they both can be stronger? And I really think that Prime Minister Carney and President Trump and his cabinet understand that. So to me, it's not as scary as some people would bring up.
You mentioned natural resources, and in Canada, I think of the energy complex being a big part of that story. So when we consider the hunger that we have now for power in particular to drive some of these AI data centers, this seems to represent a big opportunity for Canada. The question is whether there will be cooperation.
Yes. And I think the only thing that has to happen is it takes time. Right. Canada has, I lived in the States for 25 years. Canada has neglected its core competency, which is natural resources. So you just don't open a mine. You just don't build a pipeline. You just don't build a nuclear reactor. Doug, back in the 50s and 60s, Canada was a world leader in nuclear power and nuclear technology. So it just takes time. And yes, and I agree with Prime Minister Carney on this. Pipelines are boring because really what Canada needs to do is stop exporting its natural resources and start processing it and using those natural resources to create a diversified economy, which would mean AI. And I think that's the next step. So we need time. But at the same point in time, look, Canada and the United States, we're family, we fight. But at the same point in time, we will grow together in this new environment. And Canada can really help by bringing resources and critical materials and energy and natural resources to the forefront. So I am very constructive on what's going forward. And as Prime Minister Carney said at the Council on Foreign Relations, we have to adjust. We're dealing with a reckoning. And so, but that takes time. But, if you understand that, there's lots of opportunities all over the place to take advantage of that.
What about the processing of rare earth minerals? This is an industry that China really dominates in. Can you imagine a world where Canada steps up and begins developing a more robust infrastructure for processing rare earths?
Yes. When you think about the problem that Canadians have had in the past, it's been that they do not want to process natural resources because of the pollution. And I really think that Canada really needs to have an honest conversation with themselves. Let's talk about the tanker ban on the west coast of Canada, yet, tankers flow freely on the East Coast. Think about all the pipelines that we've had. So I think what's happened is we've had a decade of what I would call virtue signaling that has really cost Canada its standard of living. And so we're in the early phases of shifting. And what I would say to you is Mark Carney is a very smart man. He is a world-class central banker, but don't forget, he, cut his teeth in the private sector with Goldman Sachs and later on in Brookfield. So he understands it, but it's one thing for you and I to talk about it, but he's got to play the political battlefield up in Canada to get everything going. And he only has a minority government right now. So I think he has a handle on what's happening, but he's got to move a lot of the chess pieces. And so it's going to take time. But power is going to go south. We're going to have a few industries that are going to get hard because they were protected by USMCA. But when you have an economy that is resource rich, in the long run, we're going to be okay. So Canada has what the world wants. We've just got to get our act together and start getting it to the world market and moving forward with long duration infrastructure projects and saying to the global capital markets, we're open for business and the rules aren't going to change.
So we've talked a little bit about the relationship between Canada and the U.S., and we're well aware of the tension between China and the U.S. So I'm wondering whether you see opportunities for Canada to strengthen its relationship with China.
I think the two countries will coexist, but I don't think there will be significant strengthening. I think the tectonic plates that are happening right now is the negotiations between President Trump and Mr. Putin and also Mr. Xi. I really think that the powers to be are going to come to some agreement a peace dividend, as you will say, I will call it, so that we can get a period of time where we can all grow out of this debt mess that we're in. So no, I want to say, look, if with Premier Smith in Alberta, we build a pipeline to the West Coast and we ship, oil to China or to Asia. I think there is going to be a global trading relationship, but I don't think it's going to be anything more than that.
Okay, Jim, we'll leave it there. Always a pleasure. Thank you so very much. James Thorne is the Chief Market Strategist at Wellington Altus Private Wealth, joining from Toronto, Canada, here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.